Qualification boards. His unique training style is unmatched. He takes potentially complicated issues and presents them in an easy to understand, engaging delivery. Welcome, Drew.
As she's reading, I'm thinking, wow, 1,000 people. That was a lot of people to talk to. But if you take that over a bunch of years, I guess that works out. Okay. So if you just, let me grab this gift I brought you today. So everybody knows about this, right? A lot of different versions these days, right? The electronic version, whatever. I'm going to talk to you tonight about 1031s and how you can play that for real. Okay, so just a show of hands, who's done a 1031 in the room? We have some wholesalers in the back. I don't know if you've done. I know you have, because I could tell you're pretty experienced talking to Julian. Anybody else has done a 1031? Anybody doesn't know what it is at all? Awesome. So we're going to start basic today. And obviously we have a time limit. Just want to get you up on it, and I'm going to challenge even the people that know about it, some little different strategies that really would make it enhance to get to that. So tell me right now when I say that, have you seen how you can do that? Play Monopoly for real.
A little bit. I think I know what you're talking about. Trading the houses for the hotels and.
She's awesome. I'm not going to give you this yet because I have to do some things. All right. So first of all, what is it? All right. You want to tell me a little bit what you think it is, and let's go from there, from your experience.
Okay, it's you exchange one home for like kind, which you sell one of your properties. You can purchase. I mean, there's some rules, 2 years, every 2 years, you have to live in it for 2 out of 5, and then you can exchange it for another property, and you don't have to pay the capital gains taxes.
Perfect.
Kind of.
Not bad at all. You probably don't do many of them, which most people don't, so don't even worry about it. I didn't mean to put you on the spot, but thank you for doing that. Basically, that's the concept. Julian's talking about tax-free situations. This is another version of it. So we're in the taxable world in this world. Okay, when you get to Julian's world, you're already past that, which is why it makes it awesome. Okay, this talks about properties that you might not have put in the right holding yet. You might have just started with real estate investing. You're not sure what you want to do. So let's just talk about the basics. Here's the IRS definition. It's an eye chart on purpose. I don't expect you to read that. Okay. Basically, what it says is kind of what you just said. Okay. What they're saying is when you own a property, doesn't matter what type of property it is, whether it's land, commercial, residential. How you use it determines what you can do with it by taxes. Okay, so if you use it for a business or you use it for investment and you're holding it for appreciation, they will allow you to swap it for something else with no taxable event whatsoever, including recapture of depreciation taxes. They are deferred indefinitely. This is what they're saying here. They have to be specific about it because there's a million different variations that you can take. All right? So, and actually, here's the actual link to the IRS site if you want to see that. Again, iChart, I can send it to you. You can look it up on yours. It's very simple to find that. But it talks about, and you mentioned this too, like-kind property. One of the neat things about the 1031, the numbers refer to the tax code. Pretty straightforward, not that exotic. That's the section of the tax code that talks about this. You have other sections that also talk about swapping things. This is just about real estate, though. Okay? And when you're talking about like kind, the good thing about real estate is it's the most liberal definition of like kind. You can exchange land for a commercial property or vice versa. Most people who don't do this for a living, which most people don't, especially after real estate, it's been a little bit tough the last couple of years, don't realize that because your first educated guess is it's like kind, have to have residential, be like commercial, because it's not. The IRS doesn't care about that. They care about the use of it and your money. Obviously, that's what they care about. Okay, so we're going to talk a little bit about that. Here's the basics from a layman's perspective. Okay, first is exchanging one investment property for another, deferring the tax. No taxes due for the transaction. Okay, including recapture and depreciation. Sell an investment property, buy others of equal value. You don't have to. We can talk about that a little bit as well. Your purchase must be closed within 180 days of the sale. So when you sell, the clock is now running. 180 calendar days, doesn't matter holidays, okay? Also, you don't handle or touch the money yourself. Think in terms of what Julian was talking about, 401ks, any tax-deferred instrument, you can't be it, right? Didn't he say that? You can't touch it, you can't add to it. Same idea here. Anytime we talk about deferring a tax, they don't want you involved in it, touching the money. Pretty straightforward thought, okay? Also, you want to hire an intermediary or combinator facilitator, another version of somebody who's going to escrow the money and do the paperwork correctly. That's basically what that is. Make sense? Okay. So, why do it? Why would you defer them when you're going to have to pay anyway? Anybody have an idea about that? Why would you do that?
Present value of money?
Excellent. You an accountant?
No.
Okay, because it sounds a little
Far
bit
from it.
I was gonna say, I already got the sense because he was rattling off those numbers like an accountant, so I got that sense, okay?
Can you repeat what she said, please?
All right, go ahead. What she said was time value of money. Cost of inflation.
Okay.
Money today, loaf of bread was 5 cents 50, 70 years ago, same idea. You have use of the money now, keyword indefinitely. Okay, we'll talk later about multi-generational in a second, okay? Also, you're deferring a depreciation recapture tax. Anybody know what that is? Besides the accountant, you can pick on him a little bit. You know what it is? The expert, go ahead. I know.
Just the depreciation of your investment property that over time you get to keep rolling it over, something like that, right?
Basically, you mentioned before, what about depreciation in the IRA, right? Okay,
Because you can deduct that.
you deduct it, correct.
Right.
But when you take it out, you're gonna have to pay a part of it back.
Right.
So you're gonna recapture, they're gonna recapture, the IRS, that depreciation of part, it's actually 25%. He's gonna check with me. I'm not a CPA, but I have one in the house, so, all right? But that's the neat thing about it though, so understand how this all works. So when you're making your play, your strategy session for what you wanna do, you have these things in mind. And again, it gets more and more complicated than this, but this is enough to get you going, okay? Time value of money, she already saw my slide before, I don't know how she saw that. Redistribution of assets, what does that mean? Redistribution of assets.
You get to choose other properties
Why would you do that?
to broaden your portfolio.
Or
And
what
limit
happens?
your basis, and spreads, I'm sorry.
No, you're right, go ahead.
Yeah,
That's
you're spreading out your risk factor, I guess.
exactly. What did we just have with the real estate market the last couple of years? Right? Some people though would want to go maybe in an area that's growing. Jason was just talking about, the numbers are looking better, right? So what if all your properties are over here and this area just starts to do bad? You're stuck, right? If you sell them, now you're gonna pay and pay and pay, closing costs, the whole thing, marketing, getting rid of it, the management of it, all down. How do you get it out of that bad area to a higher growth area? And the area might not be geographical, right? Could be a different type of property. As Jolene mentioned, there's a million different versions of that. That's a big key, especially for people on the big money side. They have a lot of assets. That's what they're looking at. This is not about getting out of the taxes. This is not about cheating the IRS. This is not about working an angle.
Although you
At
could
all.
eventually, right?
Well, I'm going to tell you some strategies about that real quick, especially based on time. But the idea is that is the key factor, is using your money effectively given the situation you're in. It's not about being upset about what's happening, it's about doing something about it, right? So building multi-generational wealth, that's what I mentioned before. What does that mean? Multi-generational wealth. Anybody?
You can pass it on.
Pass it on to your children.
Pass it on to the heirs, correct. What are you doing when you're buying your real estate? What's the idea? Whether you're wholesaling, buying your first one, doing what Julian's saying, what are you doing? You're building a portfolio. This is what we call a cash cow, you hope, right? It's going to be delivering money for us, as he was saying, when you retire. Why kill the cow, though? Because you decide to pass away, and all that's going to happen to all of us. Why kill the cow? What are you going to do about bringing it to the next level? Keep that going. Hopefully, you hope so, right? But at least you leave it better than you found it, maybe, okay? That's what you can do with 1031. So let's talk about a little bit about playing the game Monopoly. You know what these are, right? Okay. Start off with one, then you get a second one, and maybe a third one. What happens in Monopoly when you get 3 houses on, actually you have 4 on
You
it?
get a hotel.
Thank you. But you just get it, Kristen? It just shows up, or what happens?
No, you trade them in.
You trade them in. So we're going 4 houses, that's their rules, right? It doesn't have to be the real world, but that's their rules. It's forcing you to think about what? Building and expanding. That's why I love it so much. I watched investors do this thing over and over again, and I was blown away. Wow, that's what they're doing. Sometimes use the exchange, sometimes an honor, whatever the fact that they need to get them to that next level, depends on where you're at, where you're going. That's all it is. So let's say you get the 3 houses, then you go to the hotel, right? You are, in the real world, what do you have to do? You don't just go there. What do you have to do to get to there? Sell them. Cost, closing cost, marketing cost, right? Days on market, all of that, right?
And you have a matter of 180 days to worry about.
Exactly right. So here's the thing. If you were to do all this, you could basically take a nice little portfolio of single-family homes, let's say, or land, whatever it is, and now trade up into a hotel. Now, why would you do that?
Kind of cash flow.
Cash flow. What is it like managing a lot of little properties versus one bigger one? Could be
Payroll.
easier. It depends on your, what was that? I'm sorry?
Payroll.
Payroll. It really, again, doesn't it depend? Okay, technically that might be the idea of making it easier on you. You're trying to get to multiple hotels. What happens if you have a hotel in this game on a couple of the properties when somebody lands on it? What happens? The rent might be more than they started with when they started the game. I won the game by playing hotel on a St. Charles place when everybody else was rushing to get boardwalk.
Right.
Okay? And we had to quit the game because it almost cost a friendship. They said, you're in real estate, doesn't count. I go, I'm out. Everybody knows the rules. It's rolling the dice. I landed on that. I chose, whatever. So let's end the game. But anyway, back in this, what happens if you go this way? Can you do that, and why would you do that? Can you do that, first of all?
Yes.
Yes,
Okay, why would you do that?
again, to diversify.
Right, let's say this, again, goes in that bad area or something happened or whatever. Could even be a personal reason, your family moves, right? You don't want to be in this area anymore, your kids, your friends, whatever. That is reasons why this could happen. You're starting to see the difference here, and this could be beneficial, right? Playing the game for real. And it's fun when you do that because you're thinking, wow, I'm going to get here, then I'm going to get there. So it's kind of how it works. Let's look at some of the boring terms real quick. All right, just to go through them. Relinquished property is the one you're relinquishing, obviously, you're selling, that's the sale one. You're replacing it with the one you're buying. Intermediary, we talked about that, that's the facilitator who handles the paperwork and holds the money. Capital gains tax, obviously we know what that is. Anybody can tell me what that is that has not done it before? Sorry. Gotta have somebody else check. What is capital gains tax?
It's the variance between the two sales.
Correct. Now, here's the thing. Some people call it profit. It's technically not profit. Anybody can tell me why that is?
Till it's exercised.
Say it again.
Till it's exercised, it's not a profit.
Well, profit talks about a business making money, turning inventory, selling goods. That doesn't apply for 1031s. These are assets. You're using them as a business use or for appreciation. So that is a gain of what you did. Same idea, but the key distinction is understanding down the road that that is really what it is. It's not profit, it's tax. Go ahead.
QI stands for?
Great question. I was going to get to that. Qualified intermediary. Somebody who's an intermediary in the transaction. Disinterested third party is technically what they say. Okay. Depreciation recapture. We already talked about that. Exchange agreement. Obviously, if you're going to hire somebody to escrow your money, do the paperwork, you need to have an agreement with them. Everything in real estate has to be in writing, right? Okay. No different here. All right. Exchange rules. Let's talk about some of them. Types of properties. Well, here's the 5 categories. Not all of them, but we're just going to touch on some of them. Rules. First of all, types of properties. Residential, commercial, and land. And Jillian mentioned TIC. Is everybody clear what that is? Tenant in common? Because we have some newer investors probably in the room. Tenant in common means is how you own the real estate. Okay, it means you're not related. So let's say, it doesn't matter the percentages, but you're on title with somebody else, and it could be an entity, whatever, doesn't matter. That means that if you pass away, God forbid, where does your portion of that ownership go? Say it again, anybody? Goes down, not across. Meaning it goes to your side, not automatically goes to the other side. Very key distinction. So people by default take that for granted, but when you buy a property with somebody you're not related to, that's what the ownership is. And you can buy it with any different variation, as Julian was saying before. All right? All of these apply in 1031s as well. Okay? Going on to qualification. What makes a property qualified? What is qualified property to exchange in a 1031? It's kind of a trick question, but really not. I want to make sure you guys understand this. How it's used.
Well, then
That qualifies it, period. There's no IRS rule, no auditing. Nobody's going to come to you and say, well, hold on, let's get the check mark on that property, now you can go. It doesn't work like that. It's how you use it, and it's always after the fact. Okay, it's after the fact. You don't even know if IRS likes the exchange until maybe years later when you're in an audit. Unfortunately. It's not registered, it's not something you have to put in there. This is how it is. So it really is key. All of it up front, as much as you do up front, that's the key. As far as your planning and understanding, making sure that you're in the right category there, okay? Also, strict timelines, as you mentioned, you have 180 days. Calendar days, doesn't matter holidays, okay? Basically, the time frame starts when you sell. That's the most standard exchange forward. Sell then buy, okay? You have 45 days to identify, that's not additional. That's the first 45 of the 180,
To
okay?
identify what?
Thank you, we're gonna get there, but that's it. You have to tell the IRS through a documentation what you're gonna buy. You can't just say, I'm gonna pick a property somewhere in the United States. It's not
So
gonna fly.
simple.
Excuse me?
It's not that simple.
It's not that simple at all. They give you very specific requirements. I'm only gonna touch on a couple of them, but that is where I love the strategy session in this whole thing. That's where you spend time figuring out which direction you're headed in. So go ahead.
So you have 45 days to identify the property. Is that
Correct.
broad or is that specific?
Specific.
What did you say the first part of that before
Is
specific?
it broad?
It doesn't matter.
So we're
It's
talking
gotta-
to buy a property in the United States.
Correct. You can buy
So you have to
anything.
show your intention.
Correct. You basically
You don't have to
have,
be specific as to
You do have
where
to
it
be
is.
specific.
Yes, you
have
do.
to choose the-
So you have to find the location within 45 days and you have to
Correct.
exercise it and honor the deed there.
right, where it's broad, it could be anywhere in the United States or US Virgin Islands, for example. Where it's specific is, it's gotta be a closable address. It can't be building 18 in a subdivision. It's gotta be a closable address. If it's a condo, what unit number it is, it's gotta be a closable address. Okay, very specific. Broad but specific, you're not limited by the area. But you can control the timeline. Why do I say that? If you cannot change these rules, why can you control the timeline?
Because you can
Identify the
identify
plan.
You can,
before you close.
Go ahead, sorry.
mm,
Almost, go
well,
ahead.
you would identify your property maybe before you would like
Close it.
you would flip your
Close enough.
procedure, I
5 minutes,
guess.
okay. We're gonna run through this quickly, because I don't wanna run over, but definitely I'll stay as long as we need to. The reason why I control the timeline is because you pick when you sell the property. Timeline doesn't start till you sell. Okay? Keep that in mind when you plan strategy, okay? So identification, we said before, taxpayer has to identify up to 3 properties by the 45th day. If you don't identify any, the exchange is over, the money goes back to you on the 46th day, you have to pay the tax. It's that simple. You gotta put at least 1 on the form, okay? There's a whole strategies about that. You can go even swap, you can trade up like the hotel scenario, you can split up and redistribute, just to give you a couple of examples, okay? The key about the filing tax and the deadline, you do have to file an 80/24 form, okay? Don't pick on accountants that don't know this intimately. Here's the tax code, here's the 1031. Okay, so that's why we like to help when we need to fill in the gaps, okay? But you do have to file a form every time you do an exchange, okay? You file that for the year past, all right? Also, exchange initiated after October 15th, you need an extension of your tax return to finish it, because that's gonna go past the April 15th deadline to finish, okay? Types of exchanges: forward, reverse, construction, simultaneous. I can talk about these later. This is the most common one. Start getting here, they get pretty exotic and very complicated, all right? Role of a QI basically is disinterested third party, holds the money, does the paperwork for the IRS, okay? Basically, that's how it is. Also, we provide training, but that's not mandatory. We cannot be your agent in the transaction, okay? Nor can anybody else who's represented you in the last 2 years. All right, give you a little bit about that, time-wise, because I'm almost done.
2 minutes.
Got it, okay. Common myths. I'm gonna put all these up on the board here and just look at a couple of them. Only the cash has to be reinvested. Not true. You sell for 100,000, you gotta buy for 100,000. Even if you had 90,000 debt on it, you gotta replace the debt. It's like kind in money. Remember I said that before? 100,000, 100,000. Not, oh, I have 50,000 out of the property, I'm just gonna reinvest the cash. No, it's not like kind, it's cash. I'm sorry, it's the total money, what they're looking for. All right? An investor can do their own exchange. Don't close on a property, pass it over to your attorney, which I watched happen, and say, put that in my 1031 account. Doesn't exist. Attorney cannot do it for you. It's too late. You close on it, you receive the money, it's over. Go to the next property, you're gonna pay tax on that one. Also, like kind means residential for residential. We already said it does not, okay? So I have some of this again. If you want more information, I can go through that with you. But definitely go to the IRS. Definitely talk to your tax professionals. Okay, and obviously you can call me anytime with any questions. I spend a lot of my time answering questions and working strategies, really. Because once we do the exchange, it's pretty straightforward stuff. It's really not that complicated. And I prefer that because it makes the transactions easier. So you're not sweating out timelines and worrying about 180 days and all that. All right? So that's it.
And questions? Got 5 minutes for questions?
Just one question, fees, are they normal fees?
There's all
Is there
fees
percentages?
across, yeah, great question. The fees are all across the board. Usually you have a flat fee, and then the intermediary collects the interest while the money sits there. Now, obviously, these days, that's not as much as it used to be.
Can the fee be part of the deal?
Excuse me?
Can the fee be part of the deal?
It cannot. Well, you can. You can make it part of your closing cost, yeah. Usually it comes in on the first page of the settlement statement as a fee to the intermediary. And it could be tax deductible, just depends on your situation. Anytime you start talking about that, you need to be real close with your tax situation, okay? Anybody else?
You know all about this, right?
About 1031 exchange? I've never done it before, but I've absolutely seen several people, several people like Drew present on it, absolutely.
Okay, because the thing that I'm thinking of is if you can't meet the requirement in 45 days, for whatever reason, closings don't happen,
Right.
they get postponed, what happens right then and there after?
You're screwed.
Literally, you
You're
just pay.
We're gonna have that conversation hopefully prior to listing it.
So it's a timing issue.
Exactly.
Absolutely.
You control the deadline. It's strategy sessions.
Absolutely.
I have had a lot that where somebody came in last minute, and I have a very frank conversation with them. It's black and white as much as I can make it. IRS is like that, but there's gray area too, but when it comes to that kind of stuff, you wanna do the homework as early as possible.
Right,
You're already thinking.
and you don't wanna have it, you already wanna have basically properties picked out, ready to go,
Exactly.
in line, and, with my driven personality,
I didn't
it's
get that
never,
sense at all.
it's never a problem.
Well, the thing about that is, let's do a real quick one on that. Let's say you're going 1-to-1, selling for $100,000, buying $100,000, it doesn't matter the numbers, but let's say that. You want 3 on the list because you need backups.
Yeah.
One doesn't fall through, you can't control. If a seller decides not to sell you their property, the nerve of them not selling you your property, you need a backup. And that's where I always say, that's why we need to know up front what's going on, because then we're gonna definitely want 3 from it. You can get away with doing 1 if you want. I don't recommend it though,
Right.
because you need backups, without a doubt. It doesn't matter the market either, I've been in both sides, seller's market, buyer's market, you still need to strategize with that.
Have you seen or done any reverse mortgages with short sales as the purchase property?
Not reverse mortgages?
I mean, reverse exchanges, sorry.
Yeah, I just finished a very complicated one, a forward into reverse with construction.
Okay, yeah.
Ooh.
I don't recommend that for everybody, that was pretty tough.
I just thought with the market that we're having and all the short sales, that it might be wise to maybe, if you wanna purchase a short sale and the length of time it's taking now,
I
maybe
don't,
do the reverse.
I would suggest not doing that as much as you can, or try to wait to sell. Because if that thing goes more than 5 months, which it can do on a
Right.
short sale, you're gonna be rolling the dice on that.
I
Not
def-
literally like this rolling the dice, but you know what I'm
Right,
saying.
okay.
Yeah, I definitely wouldn't,
Yeah.
wouldn't play with short sales. I mean, I have short sales
Right.
from 30 days to 9 months.
Right.
And also, it depends on the seller. I mean, the seller really has this, a lot of them are putting properties on the market that they never wanna move out of, so they're
Right.
trying to strategize themselves.
Right. One other point about that, when you're going to buy a property in a 1031, the last thing you wanna do is tell them you're doing an exchange. Why tell them that you have a time frame problem to buy a property?
Right.
I mean, you don't think about that, but these little tricks of the trade you pick
Oh,
up
yeah.
if you don't.
Right.
The
But
key
don't
is
you
you
have
do,
to disclose
you
it?
have to disclose it, but the way to do it is if you the current farm contract, or if you're own, as long as, most of them have language already
Right,
built
right.
in, so by signing it, you're already saying you're gonna participate at no
That's right.
liability or cost, so.
That's right.
And we give you language too, but a lot of the contracts already have now.
And Drew can answer any of your questions afterwards
Yes.
too, but